Very good afternoon, good morning, good afternoon. Welcome to HYCM's online trading workshop with myself, Giles Coughlin, Chief Currency Analyst. Hope everybody's doing well. Warren, good to see you. Jabin, Rick, just as other folks are coming in, don't forget that the whole idea of this webinar is that we look at, it's like looking over my shoulder and you see what my expectations are as we're coming up to significant calendar events. The whole idea is not trading advice, but it's like looking at how I go about making trading decisions and from an educational perspective. And today we are looking, it's the biggest trading opportunity of the week, which is looking at how to trade the US CPI decision. Now, I will be explaining this in some detail, and we will be looking at how best to trade this. So without further ado, I'm going to get stuck into this straight away, and we'll be looking at the major currency pairs that are on offer here, as well as some sort of neutral points as well. So I'm just going to go over to my other screens, and I am going to be using financial sources resources. I do work there as an analyst, and I will be sharing and using those resources don't forget, HYCM clients can get access to financial sources webinar details, and if you'd like to have more information on that, please do contact me. Now, looking at the CPI expectation, so coming up at 3:30 at GMT. Now, this is the key expectations. The headline figure is expected to come in at 7%. Now, the key metric to look at is not the headline, but it's the core reading, because the core reading is seen by the Federal Reserve as being a more accurate reflection on what inflationary pressures are really there in the economy. Now, just taking a little bit of perspective, for those of you who are new to trading, inflation is one of the key areas that central banks need to keep control of. If you remember back to when, depending on your age, but if you go back to the sort of 1980s, 70s, inflation was very high in lots of the Western world. And you may be from a country where inflation is currently very high. But inflation, thinking of my parents here in the UK, at one stage it was around 15, 16%. So that's huge when you consider, my current mortgage is 1.92%. So if you imagine a mortgage rate of sort of 15, 16%, incredible, right? Now, those inflationary pressures can be very, very intense. So central banks want to control inflation. Now, inflation at the moment is moving up to 5.4%, okay? And the way to control inflation is by rising interest rates. So when inflation moves higher, the only tool that central banks have is to increase interest rates. Now, that's why inflation is such a focus for central bankers. They are the ones that can handle inflation, and it's their core responsibility. Now, what they don't want to see is inflation getting out of control. If inflation gets out of control, impacts debt, impacts families, impacts jobs. It's, once inflation is out of control, it's a very, very bad thing. So economies obviously want to keep inflation under control. Now, this has all been complicated. If you take the last decade, now inflation has been very, very low. And part of the reason for that has been things like automation. It's been globalization. So wages have hardly seen any increases. If you think about it, because if you can be a computer programmer and you can do the job in Delhi or San Francisco or London or Portugal, it just means that, you can just move to a cheaper place, or maybe someone is just as skilled as you, but they live in a weaker economy, so they're happier to accept a lower salary compared to someone living in, the heart of London or Silicon Valley. So all of this means that there's been this deflationary pressure that's been around markets. Now, all of a sudden, we've had Omicron, then there's been these supply chain issues, then there's been these weird demand peaks for certain things. If you remember in the lockdown, do you remember like things like weights and second-hand cars suddenly saw their price, it was costing more to buy a used car than it was to buy a new car. Ridiculous. So the inflationary pressures that we've seen have largely driven by supply chains, but this is what's been going on, and this was, really alerted to me when I was speaking to Benzinger.com over in the US, a US news organization, and I speak to journalists and broadcasters as part of my day-to-day role, and this group's had me speaking about inflation for 40 minutes. So inflation is very politicized in the US. It really is encapsulating people. And yesterday we had Powell speaking in his Q&A session, and he was talking about inflation as a major focus, right? So this all tells us that inflation is a major focus for the US right now. And the inflationary data has been a key driver to Fed policy shifting. Now, at the moment, I'm just going to change charts here because I want to talk us through this. Now, if you look at the COP positioning at the moment that's going on, you can see here, look, the largest position for large speculators is long US dollar. Okay, now the reason people are long the US dollar is being because markets have been seeing this coming. They've been seeing this pivot that the Fed's going to be needing to make. Inflation's been rising. The Fed's going to have to be more aggressive. They're going to have to raise interest rates. They're going to have to end their quantitative easing program. So all that dollar strength is now in the market. So this has been pricing in those Fed rate hikes. Now, at the moment, the Fed's expected to hike interest rates 3 times. That's the dot plot by the Federal Reserve themselves. And Goldman Sachs, for instance, it could be as many as 4 times. So there's this hawkish bias, but that's priced in now, okay? Now, yesterday, we saw the dollar fall off. Why? Because Jerome Powell, yes, he was stressing what we already know, the inflationary concerns. Yes, interest rate hikes are going to have to come. We knew all this, but he was less hawkish than some of the other Federal Reserve Board members. And when he was speaking about quantitative tightening, now that is the opposite of quantitative easing. So when you've got quantitative easing, it's buy everything. When you've got quantitative tightening, it's the opposite effect of that buy everything feeling, that comes into the market. So the quantitative tightening is when the asset purchase program the balance sheet will be reduced. So the reduction of the balance sheet means there's less accommodative monetary policy for companies, and that results in the economic conditions being less advantageous for companies, etc., etc. Now, Jerome Powell was much more relaxed about the pace of that happening than maybe some of the other Fed members have been. So there was a sense in which Jerome Powell was trying to calm markets. Now, his calming impact resulted in the dollar weakening. We saw 10-year yields, which have been in a lot of focus at the moment, pulling back from that 1.8% region. Okay, so 10-year yields just pulling low. It's that March high since the start of the year. It's yields up. Everyone's been talking about yields. The whole yield curve has gone up across the curve. And now we're just pulling back from that 1.80%. Just the fact that Jerome Powell's saying, steady the ship. So into that context comes today's inflationary print. The Fed is hyper-focused on inflation. Inflationary fears have been driving yields higher. They've been driving the dollar higher. So much of that is expected. So that means today, the best trading opportunity is not going to come from inflation being high. We already know inflation's high. Economists are projecting inflation to move higher. Look, 7% for the headline, above the 6.8% prior reading. 5.4% on the core, above the prior 4.9%. So we're already expecting high inflation. Now, if inflation is high, let's say it's above the maximum expectations. That's how you use this, because minimum and maximum expectations show you the range that economists had going into the decision. So for instance, here, you can see that the range of the expectations was 5.4% was what's expected. The minimum was 5.2, the maximum was 5.6. So if the reading comes in outside of that range, that's when you get the biggest reaction. Now, what I'm saying today is if it comes in outside the range to the upside, so say the headline comes in plus 7.3 and the core comes in 5.7, that's not a massive surprise because we already know that. We already know that inflation's a problem. we already know that the Fed is being hawkish. They're expected to hike 3 times this year, possibly 4. Now, you might see a little uptick in the dollar, but will you see the dollar be able to keep moving on higher? Do you see? Because large speculators have been long the US dollar, and asset managers with that fundamental macro story are saying, look, we've priced this in. So the best opportunity comes from inflation disappointing to the downside. So if inflation is below, say, 5.2, set comes at 5.1, headline comes in 6.5, then that would result in dollar weakness. So the trade, dollar selling down to 95. Lovely, okay? Now, don't forget the dollar is paired with these other majors. So we'd also expect upside in euro US dollar. Look where the euro US dollar is, just sitting above, underneath that 1.1400 region. Now look at this on the weekly chart. You see, when you get these compressing price movements, you then tend to get explosive moves away. Do you see? Compression, move away, compression, move away, compression, move away, compression, you know, false break, move away, compression, move lower, back into the range, move away, compression, move away. So we've got a very similar move here, compression, move away. A lot of that dollar strength has already been priced in. So in other words, a little bit of a retracement in the dollar would make sense. And if there's a miss in CPI, the significance is this. If CPI misses, it means that inflationary concerns are less. If inflationary concerns are less, that means that the Fed is going to have less pressure to raise interest rates more quickly. If interest rates don't rise more quickly, then we expect dollar weakness. So that's the way that that works. So the tradable opportunity that I'm looking for is this. This is a good one. You know, I mean, this is worth me hanging around for. So core CPI below 5.2. So 5.1 is the trigger. If I get core inflation coming in below 5.1, then very simply, I want to go long euro US dollar. That's my favored trade. Another equally good trade would be dollar yen downside. Okay. Looking for a dollar yen downside and just looking for a target 150, just above 150. Give you a little tip. Whenever you're trading, if you've got targets, never have your target. So say you got 115, never have your target at like 114.96. Doesn't make sense. You got your target, put them just ahead of those big round numbers. So if you're selling into this level, just have your take profit, because you got this swing point here, just have it like 105.12. Okay. If you got your stop, say you were wanting to have a stop loss, just hypothetically, you wouldn't have your stop loss. Say you were going long, you wouldn't have your stop loss 115.05. You have the other side like 114.96. Always be the other side of big round numbers, because big round numbers, they tend to get respected and they tend to get pushed away from. Okay, so you're looking at those big round numbers, they tend to be significant. So that's what you want to look for, is a miss, and that would be a dollar yen downside. Also, New Zealand US dollar upside on a miss. That makes sense. You can see New Zealand US dollar is just sort of sitting down at this large channel. So upside makes sense. RBNZ, you know, they're looking at hiking interest rates up to 2.6% by the end of 2023. They're currently at 0.75%. Got a lot of room for RBNZ to go into. Also Australia, you know, the Fed's moved, their bond yields are moving higher, employment's been good for Australia. So any very poor readings for the US CPI, we should see Aussie US dollar move up higher, and you potentially look at a break of that potential trend line here. That will be acceptable. Now, dollar CAD's worth looking at, and I'll explain why, for a slightly different reason. Now, just take a look today. I want to show you something. Right, if you look here, it's not this one, sorry. Right, I will find it eventually. We'll find the right. Okay, I think I've closed the chart by accident. Right, let me just open it up. Right, there we go. Now, if you take a look here at currency space, what you'll see at the moment is today we've been seeing a lot of Canadian dollar strength. Okay, now just looking at today's price action, you can see that Canadian dollar has been very strong here, pulling back a little bit now. It's a bit of a surprise to see that CAD strength. So if we now the Bank of Canada, there's a 65% chance they're going to hike rates by 0.25 basis points at their next meeting end of this month, January 26th. Now, the reason for CAD's strength has been due to the commodity market, particularly to do with oil. Okay, and as oil has been moving higher, that has been supporting CAD. So just take a look here. You can see that oil supported by OPEC's policies 2 weeks ago, by the EIA revising higher their oil demand focus. But if inflation starts falling, then this really does look a little bit too. The oil markets are vulnerable for a correction. Now, I'm not selling this, I'm not getting involved in this, but I am looking for any false break at that level could be a really decent level for shorting oil. Now, the key issue to be looking at here is that the strength in the oil market has really been supporting the CAD. Now, if you just overlay dollar CAD onto oil chart, you'll see what I'm talking about. You see here, now, if I invert dollar CAD, do you see how closely it follows it? Now, that's because the largest export for CAD is oil, and the place it exports it is to the US. So in very simple terms, when oil prices rise, dollar CAD falls, right? When oil prices fall, dollar CAD rises. So a proxy for trading oil is just trade dollar CAD. So all of that means that if we take a look at the dollar CAD, if we get a very weak CPI print, okay, I wouldn't be surprised to see medium-term buyers stepping at about that 1.2450 region. And then you could put your stop maybe just the other side of 1.24, give it a little bit of room. Then we would look medium-term, we're looking for dollar CAD to keep moving higher because we are expecting the Fed to move more quickly than the Bank of Canada. Now, if you just take a look at the US 10-year yields and the Canadian 10-year yields, you can just see, okay, there's this move higher in 10-year yields, okay, in the bond yield spread between the two. So typically that will support prices. So you can see when bond yield spreads move higher between the bond yields, that should support an upside. So look out for that. Now that is looking for a medium-term dollar CAD if the CPI is amiss, and you can limit stops quite nicely. Maybe 12450, just onto that daily trend line, then maybe have like a stop to the other side of 1.2400. That would be reasonable. So it's like entering subperimeter like 1.2470 and just stops 1.2390, something like that. That would make sense, looking for a move back into that range. Now, another key markets looking at is gold and silver. Now, this is how to understand what's going on with gold. Right, it's tricky. It's tricky and it's simple. It's simple is just take gold. So gold is gold, and then the red line is the dollar, and the blue line is a proxy for real yields. Now, what all real yields are is nominal bond yields minus inflation expectations. So people talk a lot about real yields. All it is, it's a nominal bond yield minus inflation expectations. So when inflation goes up higher, then that means the real yield falls. So if the inflation expectations are moving up faster than bond yield moves, then that's when you have real yields moving lower. So the way to trade gold is you need to have a handle on what's going on with real yields. So you can use this proxy for real yields. And if you just take a look, just use the MX tip symbol, right? So this is what you want to look at. When you have the dollar and real yields moving together, that's when you get the best moves in gold. Okay, now at the moment, we've seen the dollar moving higher to start the year, and we saw real yields moving higher. Now that was a negative for gold, right? Now, what did we see after Powell? We saw the dollar moving lower. We've looked at the dollar index. We can see real yields moving lower. That's supporting the gold higher. So you see here, when you've got, look, real yields moving lower, dollar moving lower, gold moving higher. You know, like here, where's a good example? Yeah, here, real yields moving lower, dollar moving lower, gold moving higher. Real yields moving higher, dollar moving higher, gold moving lower. Okay, so if real yields keep moving lower and the dollar keeps moving lower, look for gold upside. So the reason it's complicated is because if inflation expectations, we're not just looking for an inflationary print, we have to see how that relates to the speed of nominal bond yields, and you see that through the real yields. But if you're worried, then just stick to the currency pairs. If you don't understand that, just stick to the currency pairs, and that's absolutely, that's absolutely fine. Another couple of opportunities. New Zealand dollar, Swiss franc. I do like this pair from a medium-term upside bias. Any retracements back down to that 0.6240, stops can be placed quite tightly, just around that 0.6211 region. Okay, stay above the trend line, stay with, get back below, exit. New Zealand dollar, Japanese yen. Again, looks very attractive for upside buyers. Look at the bond yield spread. Do you see the bond yield spread pushing higher between New Zealand 10-year bonds and Japanese 10-year bond yields? You see price at support. We could enter at market, stops below that 77.50 region. Okay, looks excellent. I've got an order in market here. It stops below 77.50, and I've got another order in around the 76.50 region. Stops just below. So I do think over time, look, the RBNZ, because the RBNZ expected to raise interest rates to 2.6% by the end of 2023. Bank of Japan expected to keep interest rates on hold for the foreseeable future. So this pair does make sense that it should be finding some medium-term upside, but you've got to find places to limit your risk. Okay, you don't want to just buy and then you got 1,000-point stop. That doesn't make sense. You have to find somewhere logical, because the vulnerability to this trade is that it's paired with the yen, and if risk turn off, maybe there's like an outbreak of Omicron across China. You see loads of cities shutting down, then we could see some yen strengthen, and if we see yen strengthen, then you see New Zealand dollar yen downside. Okay, there's no reason why it couldn't keep falling on yen demand. So you have to keep that in mind, and we have had a false test and a false break of that, that significant trend line on the weekly chart. Look, 1, 2, 3. That's a legitimate turn up. We had a break, a retest, rejection. Will we see a move higher? Now I'm expecting us to move back up towards that 82 region, as long as risk remains positive. Okay. So remember, the weakness of global macro trading is that that's a good price, that's a better price, and that's an even better price for entering. But do you want to be entering at market, at 78.50, and then do you want to have stops below 68? No, you don't. You don't want to have a 1,000-point stop. So what you have to do, I say have to, what I like to do, there's two ways around it. One, just find nice key levels to enter, technical levels, brilliant. Or the other option is to use like the average true range. So find out what the average true range is for the pair, and then just put your stops like 1.5 times the average true range. So, particularly if you're convinced that the pair's moving higher immediately, then having stops of like 1 times or 1.5 times the average true range will just give you the confidence saying, in a normal week over the last sort of, 14, 16 days, or maybe 14, 15 weeks, it's never gone, more than, 140 points, 150 points. And that gives you the conviction, especially if you're like so convinced that, this is it, it's bound to be higher from here. Right, folks, I hope that makes sense. I hope that's all getting you ready. Remember a couple of things. So don't forget, if you're finding these things helpful, could I ask a favor? When on the Twitter feed, my Twitter feed, could you please, if you ever see these, and I know some of you are very, very good at this, and I do appreciate it, If you like my webinars, could you just like it or put a comment underneath or retweet it? And it's just a way of like keeping the promotion for HYCM. So if you see that, please could you do that? And my Twitter handle is @GilesCoughlinCCA, @GilesCoughlinCCA. I'll just put that in the Q&A. Watch out, and also if you see anyone impersonating me, please do watch out. I get sadly I get a steady trickle of people impersonating me. So if you do get a message from me, just double check it's me. You can always get, I've given you my right Twitter handle. I found someone else today who was actually ended up following my wife's account, and had it was a very good counterfeit, and I really hated it because I don't want people to see the guy selling some product, and some rubbish product, some scam. So just watch out for that. If you've got any questions, please do ask. Thank you very much for your comment, Jabin. I'm really glad you're learning a lot. Don't forget you can ask any questions that you want during this webinar, and don't forget we'll have the look ahead on Monday, and I'll be looking forward to Australian employment data. I think it's going to be a big one, and I'll explain the reasons why on Monday. Okay, folks. Well, thank you all very much again. I like these sessions, particularly making things clear. I hope that makes sense. I hope you've got a good sense of what to do with this CPI print. Okay, hope that's making sense to you all. Excellent. All right, folks, take care and look forward to speaking to you soon. Thank you, and we'll be in touch. Thanks, everyone. Now, have a good rest of the session. Goodbye.